Trisura Group just narrowly beat Q2 2026 bottom line consensus, but they missed significantly on the top line. Operating EPS came in at CAD 0.76.
which just edges past the street's CAD 0.7575 estimate.
Right, and GAAP diluted EPS hit CAD 0.89. But the top line, gross premiums written actually contracted 3.4% year over year, down to CAD 870.25 million.
Yeah, that missed the Wall Street estimate of 943.91 million by, well, a pretty massive margin.
Totally. And management's guidance, they're expecting mid-teens net insurance revenue growth for primary lines and surety for the full year. But they did warn about some tough second-half comps.
Yeah, and they explicitly noted that their newly acquired California surety license is going to yield basically zero premium impact until 2027.
Right, because of those brutal regulatory filing timelines.
Exactly. And, the stock reacted exactly how you'd expect to a mixed bag like that. Shares initially dropped about 2.07% after hours trading.
Algo's just panicking over that top-line miss.
Oh, entirely. But they recovered during the regular Friday session once the market actually digested the underwriting quality.
Yeah, closing up 1.07% near CAD 42.17. So that's the headline data. But for this deep dive, I want to unpack that top-line miss versus the bottom-line beat, because that intraday recovery tells you that human analysts looked at why that premium volume shrank and actually liked what they saw.
They did. A 7.8% GPW miss looks terrible on a terminal screen. But this contraction was a highly deliberate, margin-preserving pullback.
Right, in the Canadian fronting division.
Exactly.
Yeah.
We're seeing intense competition and rate softening in that specific market right now. So management just looked at the pricing and realized the math wasn't working.
They walked away from underpriced business.
Yeah, they chose to shed gross volume rather than take on a poorly priced risk that would just crush their underwriting margins down the road.
It's like a disciplined poker player, right? You're sitting at the table getting dealt absolute garbage hands in Canadian fronting. The amateurs, the algorithms want you to play every hand just to keep your chip stack moving. They want vanity volume.
Bleeding chips just look busy.
Exactly, but Trisura just folded. They sacrificed the vanity volume to protect their bottom line.
And you can see the absolute proof that this worked when you look at net insurance revenue. Because they seeded the low-margin business, actual net revenue grew 1.4% year over year to CAD 198.42 million.
Wow. So they made more money by writing less overall business?
Essentially, yes. It proves their risk retention strategy is working. If you're shedding bad business, you have to look at how profitable the retained book is.
Right. The primary lines, surety, corporate, warranty.
Yeah, and those remain highly resilient. Net insurance revenue grew 6.6% there. Corporate insurance was the massive standout, with a 60% surge in underwriting income.
60%? Wait, what's driving that?
It's largely driven by specialized product development and their expanding scale in the U.S. They're finding these profitable niches and hitting them hard.
Okay, so that brings us to the margin metrics. Because combining that massive growth in primary lines with the pullback in fronting, the combined ratio improved to 84.9%.
Right, which breaks down to a 32.8% loss ratio and a 52.1% expense ratio.
So for every dollar of net insurance revenue earned, they're generating, about 15 cents of pure underwriting profit?
CAD 0.151 to be exact. And that places Trisura in the elite tier of global specialty underwriters.
Yeah, let's put that in context against their peers for everyone listening.
Sure. So Skyward Specialty is running an 89.5% combined ratio. Trisura is operating right alongside Palomar at 84.5%. And they're sitting just behind Kinsale Capital, which is the E&S benchmark, usually in the low 80s.
Okay, wait. I have to push back here for a second.
Go for it.
Before we crown them the kings of specialty margins, we have to talk about the warranty segment. Management admitted they're seeing elevated claims volatility on select warranty programs.
Yeah, they did flag that.
They literally said warranty combined ratios are expected to run slightly above historical levels. So, is a sub 85% consolidated combined ratio truly sustainable over the next few quarters, or is this just a favorable blip?
That's a fair question. The warranty volatility is a real drag. But you have to look at the diversified nature of the primary lines. That 60% surge in corporate insurance and the mid-teens growth in surety provides a massive cushion.
So you're saying the strength elsewhere absorbs the warranty hit?
Right. It might fluctuate a point or two, but their pricing discipline in Canada proves they aren't going to just sit there and let one segment sink the ship. Structurally, that elite profitability tier looks very sustainable.
And that profitability fuels their organic capital generation, which leads to the huge balance sheet milestone this quarter. Total book value surpassed CAD 1.0 billion.
achieving their 2027 strategic objective more than a year ahead of schedule.
Yeah, book value per share climbed 20.2% year over year to CAD 21.19. I mean, over 5 years, they've compounded book value at 26% annually.
That velocity is incredible. And they're using that fortified balance sheet to aggressively expand their U.S. surety footprint. They're up to 48 states now.
Right, they just secured licenses in Minnesota, Hawaii, and obviously the massive one, California.
Yeah, but a license is just a piece of paper if you don't have the capital to back the underwriting. So they pre-funded the U.S. surety balance sheet with USD 150 million in dedicated capital.
Partially aided by that CAD 200 million notes offering from Q1, right?
Correct. But even with that debt, their debt-to-capital ratio is highly conservative at just 16.5%.
Okay, but here's my observation on this U.S. expansion. There is an immediate mathematical downside to this massive capitalization.
The ROE drag.
Exactly. Operating return on equity dropped 1.9 percentage points year over year down to 16.7%.
It's the denominator effect. They aggressively inflated the equity base with that 150 million, and the current net income just can't keep up in a single quarter.
It's like, okay, imagine building a massive, fully stocked flagship, Costco in California. The shelves are packed with inventory, the staff is hired, but the city won't give you the final permits for a year.
So the doors are locked.
Right. The capital is just sitting there diluting your ROE because, as they noted, California regulatory rate filings take forever, so they won't generate a dime of premium from it until 2027.
That's a great analogy. It's a short-term efficiency drag to build a long-term strategic moat. And that tension is exactly what has Wall Street analysts completely split on this stock right now.
Yeah, post-earnings consensus is hovering around a target price of $57 or 47 cents, which, implies roughly 36% upside.
But the execution expectations under the hood are very mixed. RBC Capital Markets maintained an outperform and a C$60 target. They're clearly leaning into the balance sheet milestone and the long-term U.S. compounding.
But then Scotiabank downgraded them to a neutral hold, and CIBC lowered its target to C$55. Plus, 4 different analysts revised their near-term earnings estimates downward.
Right, so let's synthesize that bear case. The cautious analysts are looking at the cooling of the specialty markets expansion phase.
Plus that persistent volume drag from the shrinking Canadian fronting business we talked about.
Exactly. Add in the warranty claims volatility, and then there's a modeling issue with surety. Management warned that Q2 2025 had unusually high project volumes.
Oh, right. So they have freakishly tough comps coming up next year.
Yeah, which means surety growth is going to mechanically look much slower in the second half of 2026. If you're a momentum analyst focused on the next 2 quarters, the locked doors in California plus those tough comps make a downgrade entirely logical.
It really is a masterclass in disciplined capital compounding, though. They're sacrificing top-line gross premium vanity to fiercely protect a sub-85% combined ratio, and they crossed the billion-dollar book value mark a year early.
They're playing the long game.
Which leaves you with one really provocative question to ponder as an investor. If Trisura is willing to absorb a short-term hit to revenue growth and intentionally dilute its own ROE just to pre-fund a USD 150 million war chest.
What happens to their competitors?
Exactly. What exactly happens to their competitors in California when that regulatory red tape finally clears and that capital is unleashed in 2027?
That's going to be fascinating to watch.
It really is. Be sure to follow the deep dive for daily earnings coverage and market analysis.